There's a number buried in a government report released 3 days ago that most people will never see. $770 billion. That's how much U.S. Treasury debt China officially holds right now, according to the latest Treasury International Capital data from November 2024. And if you think that sounds like a lot of money, you're right. But here's what they're not telling you. 2 years ago, that number was $870 billion. 5 years ago, it was over $1 trillion. And in 2013, at the absolute peak of what economists lovingly called chimerica, that beautiful symbiotic relationship where China made the stuff and America bought the stuff, Beijing was sitting on $1.32 trillion in American government IOUs. They've cut their position nearly in half. That's $550 billion that quietly walked out the door. And nobody rang a bell. No press conference. No announcement. Just a slow, relentless, calculated exit from the largest financial relationship in human history. Now, if you're watching this and thinking, okay, so China sold some bonds, what's the big deal? Then you're thinking like a normal person. And that's the problem, because this isn't normal. When the second largest economy on earth spends a decade dismantling a financial position this large, they're not rebalancing a portfolio. They're preparing for something. Let me explain why this matters right now, in January 2025, more than it ever has before. For the last 40 years, the entire global economy rested on a very simple deal. China would sell us cheap electronics, furniture, clothing, everything. We would pay them in dollars. And then, instead of spending those dollars, they would lend them right back to us by buying U.S. government bonds. It was a closed loop. We got flat-screen TVs, they got interest payments. Everyone was happy. This system kept American interest rates low. It kept Chinese factories humming. It kept global trade flowing smoothly. Economists had a name for it, vendor financing. China was both the store and the bank. They sold us the goods, then financed the purchase. It was brilliant, it was efficient, and it worked flawlessly for 2 decades. But that loop is broken now, and the question everyone's avoiding is the simplest one. Why? Let's start with what we know for certain. China didn't just reduce their treasury holdings a little bit, they didn't trim around the edges, they liquidated. From the peak in 2013 to today, they've offloaded over $500 billion in U.S. debt. But here's where it gets interesting, the timing. Throughout 2023 and 2024, the U.S. bond market was in what traders politely call a challenging environment. Interest rates were rising fast. The Federal Reserve was hiking aggressively to fight inflation. And when interest rates go up, bond prices go down. It's an inverse relationship, always. So anyone selling U.S. treasuries during this window wasn't just selling, they were selling at a loss. In asset management, you learn one rule very early. Never sell a losing position unless you absolutely have to. Either you're desperate for cash, or you believe the asset is about to get worse. We know China isn't desperate for cash. Despite all the headlines about their property crisis and demographic challenges, China still runs one of the largest trade surpluses in the world. They export more than they import, which means they're generating dollars every single month. So that's not it, which leaves the second option. They think the asset is toxic. Let's walk through the math of what actually happens when China sells a treasury bond. Say Beijing holds a 10-year U.S. Treasury bond they bought back in 2020 at face value, $1,000, yielding 1.5% annually. It's January 2025 now. Interest rates have spiked. New 10-year bonds are yielding 4.5%. The bond they're holding is now worth maybe $750 on the open market because nobody wants a bond paying 1.5% when they can get 4.5% elsewhere. If China sells today, they take a $250 loss per bond. Multiply that by hundreds of billions, and you're looking at tens of billions of dollars in realized losses. Any rational financial actor would wait. You'd hold the bond to maturity, collect your interest, get your principal back. But China's not waiting. They're selling into the worst possible market conditions. And that tells you everything. There's a date that changed everything for Beijing. February 24th, 2022. That's the day Russia invaded Ukraine. And within 72 hours, the United States and European Union did something that shocked every central bank on the planet. They froze $300 billion of Russian foreign exchange reserves. Not Russian oligarchs' yachts, not private assets, central bank reserves, sovereign funds, money that was supposed to be untouchable under international law. It was sitting in accounts in New York, London, Frankfurt. And overnight, it was gone. Russia couldn't access it, couldn't move it, couldn't use it. With a few keystrokes and some executive orders, the West turned $300 billion into a number on a screen that might as well have been zero. Now put yourself in Beijing's position. You're sitting on $870 billion in U.S. Treasury bonds at the time. You have territorial ambitions regarding Taiwan. You have ongoing tensions in the South China Sea. You have a complicated relationship with Washington that's getting more complicated every year. And you just watch the West freeze a major power's reserves without breaking a sweat. What do? You get out. Because those Treasury bonds aren't an asset anymore. They're a hostage. This is the part that nobody wants to say out loud, but it's the only explanation that fits the data. China is conducting a strategic withdrawal from the US financial system because they believe at some point in the next 5 to 10 years, there's a non-zero chance that the US will freeze their assets. Maybe it's over Taiwan. Maybe it's over trade. Maybe it's something we haven't even thought of yet. But the risk is now real, and China's response isn't to complain about it or negotiate. Their response is to quietly, methodically, remove every dollar they can from American jurisdiction before the door gets locked. They're willing to eat a 15% or 20% loss today to avoid a 100% loss tomorrow. That's not panic, that's strategy. Now, here's where the story gets even stranger. When the second largest holder of your debt starts dumping hundreds of billions onto the market, basic economics says the price should collapse. More supply, less demand, prices fall. In bonds, falling prices mean rising interest rates. If China's exit were happening in a vacuum, we should be seeing US Treasury yields spiking to levels that would cripple the economy. Mortgage rates would explode. Corporate borrowing costs would skyrocket. The interest payments on the $36 trillion national debt would become genuinely unsustainable. But that hasn't happened. Rates have risen, yes, but the market hasn't broken. Why? Because someone else is buying. Let me show you something in the data that most analysts aren't talking about. While China's line item in the Treasury International Capital report is dropping like a stone, other line items are surging. Specifically, the United Kingdom and Belgium. As of the latest data, the UK now holds over $750 billion in US Treasuries. That makes them the second or third largest foreign holder, depending on the month, right alongside Japan. Now, stop and think about that for a second. The UK economy is roughly 1/6 the size of China's. Britain doesn't run a massive trade surplus. In fact, they run a trade deficit. So where's Britain getting $750 billion to lend to the US government? They're not earning it by selling goods, which means they're borrowing it. The UK is leveraging its own balance sheet, using its own creditworthiness, to act as a buyer of last resort for US debt. Then there's Belgium. Belgium's holdings have jumped to over $330 billion. Now, Belgium is a lovely country, great chocolate, fantastic beer. But it's a small economy. So why is Belgium suddenly one of the top holders of American government debt? Because Belgium is home to Euroclear. Euroclear is one of the world's largest securities depositories. It's the plumbing of global finance. When you see Belgium in the Treasury data, you're often not seeing the Belgian government. You're seeing masked transactions. Other central banks, sovereign wealth funds, financial institutions that want anonymity, they route purchases through Euroclear. It creates a layer of fog, but the timing is impossible to ignore. As China sells, Belgium and the UK buy, almost dollar for dollar. This is what I call the bagholder alliance. And it's not a free market phenomenon. Think about it. Why would any rational investor in London or Brussels aggressively buy US Treasuries right now? The US is running a $2 trillion annual deficit. Inflation is sticky. The currency is being weaponized in geopolitical conflicts. Buying US debt in this environment is not a slam dunk trade. And yet, America's closest allies are loading up. This suggests coordination. Washington is effectively telling its partners, if you don't step in and absorb what China's dumping, our bond market breaks. If our bond market breaks, the entire global financial system breaks. And if that happens, we can't protect you. It's not a request. It's a polite form of coercion. The West is cannibalizing its own balance sheets to keep the US Treasury market stable. But here's the fatal flaw in this strategy. Capacity. China had seemingly infinite capacity to buy US debt because they were the factory of the world. They earned real dollars by selling real goods. The UK and Belgium and even Japan don't have that capacity. They're already dealing with their own debt problems, their own slow growth, their own economic fragility. By forcing them to buy treasuries, the US is draining liquidity from its own allies. It's weakening the edges to protect the center. And that can only last so long. Here's what nobody's talking about. If the UK economy stumbles, and remember, they nearly had a pension fund crisis in 2022 during the Liz Truss debacle, they might need to sell those treasuries to raise cash for themselves. If Japan, which is the largest foreign holder at over $1.1 trillion, faces another currency crisis and needs to defend the yen, they'll have to sell treasuries to get dollars. And if that happens, the bid disappears. There's no backup buyer. At that point, the Federal Reserve becomes the only option. They'll have to print money and buy the bonds themselves. That's called monetizing the debt. And when you monetize the debt, you destroy the currency. China knows this. They're playing a game of attrition. Every billion they dump forces the Western financial system to find $1 billion in liquidity. It pulls capital away from productive uses, like infrastructure or technology or factories, and funnels it into the black hole of refinancing American debt. It's a slow bleed. So let's talk about what China is doing with the money. When China sells a U.S. Treasury bond, they get paid in dollars. But as we've established, they don't want dollars. Dollars are traceable, they're freezable, they're inflatable. So what are they buying instead? Physical stuff? Commodities? Raw materials? Things you can touch. Things the U.S. Treasury Department can't seize with a phone call. Start with gold. According to official data, the People's Bank of China has been buying gold every single month for over a year and a half. But the official numbers are almost certainly understated. If you look at withdrawals from the Shanghai Gold Exchange, which is the primary channel for gold moving into China, the volumes are significantly higher than what the central bank reports. They're accumulating at a pace we haven't seen since the 1970s. Gold has one key characteristic: no counterparty risk. It's not someone else's liability. It can't be frozen by the SWIFT system. It doesn't depend on the creditworthiness of a government. By swapping U.S. debt for gold, China is moving from a system based on trust to a system based on collateral. Then there's oil. China imports about 70% of its crude oil. That's the single biggest strategic vulnerability they have. In a conflict, the U.S. Navy could blockade the Strait of Malacca and choke off their energy supply. So what's China doing? They're buying oil at record levels and stockpiling it. Recent estimates suggest China's combined commercial and strategic petroleum reserves are approaching 1.5 billion barrels. Satellite analysis shows massive new storage facilities being built. Underground caverns, coastal tank farms. They're building a buffer that could sustain their economy for months, possibly over a year, even if not a single tanker reaches their shores. And where's the money coming from? Treasury sales. Now let's talk about copper. China's property market. Historically, the biggest consumer of copper is in a depression. Real estate construction is down. New housing starts have collapsed. And yet, China imported over 28 million tons of copper ore and concentrate in 2024. That's near an all-time high. If you're not building apartments, why do you need that much copper? Because copper isn't just for plumbing. It's for electrical grids. It's for renewable energy infrastructure. It's for military hardware. It's for drones, artillery shells, electric vehicles, naval ships. China is stockpiling the raw materials of a 21st century war economy. And they're doing the same with cobalt, lithium, rare earth elements, nickel. They're cornering the market on the physical inputs that matter. And then there's food. China has 20% of the world's population, but only 7% of the world's arable land. That's a massive vulnerability. So they've accumulated the largest grain reserves in human history. According to U.S. Department of Agriculture estimates, China now holds roughly 60% to 70% of the world's total corn and wheat reserves. They have enough grain stockpiled to feed 1.4 billion people for over a year without importing a single kernel. They're trading interest payments on bonds for calories. Let's zoom out for a second. A country that plans to stay at peace keeps its wealth in efficient, liquid, interest-bearing assets. You want return on investment, you want your money working for you. But a country preparing for conflict does something different. They accept inefficiency in exchange for security. Holding 500 million tons of copper in a warehouse doesn't pay interest. In fact, it costs money to store, but it has a return on survival, and that's the shift we're witnessing. China is willingly taking a lower financial return today to ensure they can't be strangled tomorrow. Western economists look at this and laugh. They're terrible investors. They sold at a loss. They're hoarding commodities with negative yields. But Beijing isn't thinking in quarterly earnings. They're thinking in decades. If you sell a bond at an 80% loss but use the money to buy oil that will keep your lights on during a blockade, that's not a bad trade. You're swapping fake wealth for real wealth, paper for metal, promises for physics. So let's talk about what this means for the rest of us. For 40 years, the 60-40 portfolio was the bedrock of retirement planning. 60% stocks, 40% bonds. Bonds were the safe part, the ballast, the thing that didn't move much and paid you while you waited. That era is over. The U.S. Treasury bond is no longer a risk-free asset. It's a geopolitical instrument. It's an asset class that depends entirely on the kindness of strangers. And those strangers are becoming adversaries. If you hold long-term U.S. government bonds right now, you need to understand duration risk. Duration measures how sensitive a bond's price is to changes in interest rates. A 30-year Treasury bond has very high duration. If rates rise by just 1%, the price of that bond can drop 15% to 20%. As China continues exiting, and as the structural pressure on the Treasury market builds, the long end of the yield curve is vulnerable. Even if the Federal Reserve cuts short-term rates, the long end, which is driven by supply and demand, not Fed policy, could spike. And if yields spike, bond prices collapse. So here's the first rule: shorten your duration. Don't hold 20-year or 30-year Treasuries. Don't hold bond ETFs like TLT that are loaded with long-dated paper. If you want safety and liquidity, keep cash and Treasury bills that mature in 1 to 6 months. Short-term bills have almost zero duration risk. They act like cash, but they still pay you a yield. Second rule, follow the smart money into real assets. China is selling paper to buy stuff. You should consider doing the same. Your portfolio needs exposure to commodities, energy, metals, things with intrinsic value. This isn't just about making money, it's about inflation protection. Think about the end game here. If China dumps their remaining $770 billion, and if the Allies eventually tap out, who's left to buy U.S. debt? The Federal Reserve. They'll have to print trillions to monetize the deficit. And when they print trillions, the value of the dollar falls, and the price of stuff goes up. That's the inflationary spiral. So you want to own the stuff, not the currency that buys the stuff. If China's hoarding copper, you want exposure to copper miners. If they're hoarding oil, you want energy producers. If they're buying gold, you want the metal itself. These assets act as hedges against currency debasement. Third rule, watch the allies. You need an early warning system. Monitor the currencies of the key players propping up the Treasury market. Specifically, watch the British pound and the Japanese yen. Japan is the largest foreign holder of U.S. debt, sitting on over $1.1 trillion. But Japan is also fighting to defend its own currency. The yen has been under enormous pressure. If the yen collapses toward 160 or 170 against the dollar, the Bank of Japan will have to intervene. And to get the dollars they need to buy yen, they'll have to sell treasuries. If Japan joins China in selling, it's over. That's the moment the Fed steps in, not because inflation is defeated, but because the treasury market is broken. Here's what's keeping me up at night. The current stability in the bond market isn't real. It's artificial. It's being held together by political pressure, by backroom phone calls, by allies being told they have no choice. But political arrangements are fragile. They last until the voters at home get angry, or until the currency crashes, or until someone's economy breaks. And when that prop gives way, the adjustment won't be gradual. It'll be violent. Let me leave you with this. The $770 billion that China still holds in U.S. treasuries isn't a stable number. It's a countdown. Every month, that number drops. In the most recent data, they shed another $18 billion in a single month. And at that pace, they'll be completely out in 3 to 4 years. But here's the thing. Pace can accelerate. If tensions flare over Taiwan, if sanctions get threatened, if the geopolitical temperature rises even a few degrees, China could dump the rest in a matter of months. And if that happens, the Western financial system will face a test it hasn't seen since 2008, maybe worse. The divorce between the world's two largest economies isn't theoretical anymore. It's not something economists debate at conferences. It's happening right now, in real time, in the boring pages of Treasury reports that nobody reads. China is clearing the decks. They're liquidating financial ties, stockpiling physical resources, and building economic walls. They're preparing for a world where the dollar doesn't matter, where American leverage disappears, where survival depends on what you can hold in your hand, not what's promised on a screen. And the West is responding by forcing its own allies to absorb the blow, draining their resources, hoping the system holds just a little bit longer. This is the quiet separation. No dramatic speeches, no declarations, just data, just flows, just a slow, methodical unwinding of the financial architecture that held the world together for half a century. And the question isn't whether it's happening. The question is what happens when it's done.